welcome back to DukascopyTV. Now, the Eurozone debt crisis continues to weigh heavily on homeowners, policymakers and investors alike. Joining me today for a wrap-up of the recent situation in Europe is Aidan Manktelow, Director at Economist Corporate Network. Aidan, thank you for joining me. Now, another week, another onslaught of bad news, it seems, for Europe. We've had three nations with the AAA ratings are in running risk of losing this status, and also disappointing PMI figures were released yesterday. Aidan, in your opinion, what sort of implications do you think these sort of recent events will have on the markets?
Well, the big question for the markets and for the European economy more broadly is whether we are now on the brink of a breakup of the Eurozone. Because a Spanish bailout with about 300 billion euros being talked about, that would really be at the outer edge of what the Eurozone could afford. And then if Italy were dragged in as well, you would at that stage need to see either sort of very rapid moves towards much deeper integration, or you'd be looking at potentially the entire southern periphery splitting off. And that would tip the Eurozone economy into depression and would clearly be disastrous for the markets. Despite the headlines, I'm not sure actually that Spain is going to be getting a bailout immediately. Spain could actually manage to fund itself for a few more months yet, and also the EU isn't really ready to bail out Spain yet because it's down to about 200 billion euros in the EFSF, and we're waiting the new bailout mechanism. The European Stability Fund is still in limbo, while the German Constitutional Court waits to rule on it. So I think this situation could drag on for potentially quite a few more months yet. And while that's the case, even if you assume that the Eurozone holds together, at least in the short term, the uncertainty is clearly damaging the Eurozone economy. It's pretty much flat in the first quarter. Most indicators suggest that things deteriorated substantially in the second quarter. And then you had these disappointing PMI numbers out yesterday. Germany, I think you're looking at, it was the worst figure since mid-2009. So, I mean, even going into the second half, we're looking at the Eurozone economy remaining in recession and not really starting to recover until 2013. And even then, you're looking at quite weak growth.
Now, obviously, these events that we've discussed are likely to have repercussions outside the 17-nation bloc. And this in mind, do you think that maybe the US is in risk of, a further recession?
Absent a breakup, I mean, the Eurozone crisis is clearly impacting the US, and it's one reason why the US's recovery is currently pretty weak for what you'd expect at this stage, coming out of the kind of recession that it had in 2008, 2009. Obviously, there are very deep financial linkages between the US and Europe. Absent a breakup of the Eurozone, I don't think the US is actually short-term looking at tipping back into recession. But it is looking pretty sluggish. The labour market, which is key, pretty much stalled in March and has been very weak ever since then. So the last jobs data, like June, 80,000 jobs created. That's the third straight month below 100,000, and you'd really want to be looking at about 250,000 for this stage of a recovery. But I think the US consumer is showing, just enough resilience to assume that the US can, absent further worsening in the Eurozone, stay out of recession. The big worry for the US, aside from the Eurozone, is this looming fiscal cliff at the beginning of 2013. And that, you're looking at a fiscal contraction of the order of 5% of GDP. We actually think, you could see political agreement to avoid the worst of that. But there you are looking at a sort of real danger early next year of the US tipping back into recession.
Okay. And what about the other emerging markets? What is your outlook in regards to those?
Well, emerging markets are still very much the kind of bright spot for the global economy, but actually even there things have been weakening quite considerably. The key one to note is obviously China, where growth was just 7.6% in the second quarter, the weakest since 2009. Now, I think actually you could argue that the Chinese authorities have managed to do a decent job of managing the economy down. And we do still think that we're starting to stimulate a little bit now with interest rate cuts, the central bank doing a bit cuts in reserve requirements. We do think the Chinese authorities will be able to keep growth just above 8% this year. If you look elsewhere in the emerging world, I mean, similarly, you're seeing a slowdown, which is kind of a good thing because the previous rates of growth weren't really sustainable. The worry is that sort of combined with the weakness in the Eurozone, some big emerging economies are actually starting to look pretty weak. That would include India and also Brazil, where we're now looking, I think, at growth of just around 2% this year.
And finally, taking everything into consideration that we have discussed, what do you think this will have in terms of global growth, Aidan? What do you think this really means?
Well, I think if you assume that the Eurozone crisis could potentially drag on for quite a few more months yet, which would be our kind of baseline scenario, I think in that case you're looking at maybe even another year of the global economy being in this situation of very weak growth and very susceptible to downside risks. So we think, I mean, the global economy basically stalled in the second quarter of this year. We think you're looking at growth of maybe just about 2.1% for this year. Which is it's not disastrous, but it's pretty disappointing. And I think particularly with the situation in the Eurozone, probably it's going to be about 2014 before global growth gets back to something around, say, 4%. And just to put that into context, that's still pretty moderate. You'd want to see growth of around 5% globally, really, to sort of start making a dent in unemployment figures. So it does look like we're going to be stuck in this period of uncertainty for at least quite a few more months yet, which is obviously bad news for markets.
Aidan, thank you very much for joining me. Now, that's all we have time for at the moment, but the DukascopyTv team will be bringing you exclusive interviews throughout the week, so do stay tuned. For now, goodbye.